Hello and welcome to another episode of the AutoTalk podcast. And we put these things out on video now, so you could be watching this not as a podcast, but as a video on our YouTube channel. Either way, don't forget to like or subscribe this video. Now, we're recording this on the first day of level 3 for a lot of the country, but for us up here in Northland, it's still level 4 and of course Auckland as well. And I suspect that when this comes out, a lot of you will still be in level 4, but we're doing it for a really important reason, so let's not forget that. Now, our guest today also does an awful lot of important work for the automotive industry, but may not necessarily be known to a lot of dealers or brands out there. And if I bring her into the room, welcome Lyn McMorran, the Executive Director of the Financial Services Federation.
Thanks very much, Richard. Pleasure.
Now, we've got you here today to talk about a really important topic, a really significant topic for the automotive industry this year, among so many others. Dealers are dealing with so much this year, and they've got one more thing to deal with, and that is, and it's a very long name, the Credit Contracts and Consumer Finance Act 2003, or we'll shorten to a CCCFA. I always seem to say CCFA for some reason. Now, this is going to bring a lot of change to the way people sell and supply finance and insurance products in the market. And it's gone through quite the change. Can you tell us what's happened over the last little period as this has been done? And what's the Financial Services Federation role been in that?
Fine, thanks, Richard. That's quite a big question, actually. When you say that there's been a lot happening for dealers, and this is just one of them, I have to say this is a really big one. So it might help if I just explain who the Financial Services Federation actually is. We are the industry body for responsible non-bank lenders. So a lot of our members are motor vehicle finance providers, such as your Toyota Finance, Mercedes-Benz, BMW, Community Financial Services, Enterprise Motor Group, UDC. There's a number of them. Most of our members are involved in some way in financing motor vehicles. So for a lot of your dealers, the dealer networks, the finance provider would very likely be one of our members. And the purpose of the Financial Services Federation is mainly to advocate on behalf of the sector, the non-bank lending sector, to government. And so, yeah, we have been doing an awful lot of work. We tend to call it the triple CFA. It floats off the tongue a bit better. And we've been doing a lot of work on the changes that have been coming up. So where it all started was that back in October 2018, the then Minister of Commerce and Consumer Affairs, Chris Farfoy, announced that he wanted to make some quite wide-ranging changes to the triple CFA on the basis that he was still seeing that there were a lot of irresponsible and unscrupulous lenders out there targeting particularly vulnerable consumers and communities. And
they've used the term the loan sharks.
The loan sharks, precisely, and they were basically providing them with lending that was unaffordable and getting themselves into spirals of debt. And we agreed that there was definitely some egregious behaviour going on out there. We certainly agreed with that, but our point of view has always been that actually it was always against the law to lend money to people who couldn't afford to repay it, and that what was really required was actually enforcement of the existing law by the regulator, which is the Commerce Commission, to ensure that that kind of thing wasn't happening and to ensure that consumers were adequately protected. The Minister disagreed, so we went through a very long process of changing the Act itself. So this is, as I say, it's a process that started back in October of 2018 and is coming to fruition as of 1 October this year. So it's been, as I say, it's taken a long time, because what's been required is to change the Act itself, which means going through Parliament and the parliamentary process. That takes a long time. Then actually developing regulations to support the new legislation itself. So regulations around things like the assessment of affordability and suitability of the loan, and also to update the Responsible Lending Code. So all through that process, we have been submitting to government. We have been talking to the Minister, which is now Dr. David Clark. We have been we've appeared in front of Select Committee. We've been part of the Responsible Lending Code Advisory Group that's set up by the Ministry of Business and Innovation and Employment, which is fed into the new version of the Responsible Lending Code. And all the way through, we get listened to. So too do consumer advocates. So do those people who work on the coalface and see a lot of the really irresponsible behaviour. And they tend to have a different view from us because the people that they work with are people who may have been put in a difficult position by a lender not following the rules. Whereas we see our members who are responsible lenders who are actually willing compliers and want to follow the rules. And we see the vast majority of loans going out there that are being made responsibly. So there is a bit of a tension there. And I guess, whilst the whole regime is going to be a lot more rigorous than it was previously, and there's going to be a lot more requirements on lenders in particular to verify information that consumers provide to them, all of that sort of thing. Actually, it could have been a lot worse. So throughout that 3-year process, we've seen several iterations of proposed regulations that were even more onerous than what we've ended up with. So I guess, whilst we're not necessarily happy with what we've got, we are certainly in a better place than we would have been. And I guess that's where the Financial Services Federation comes into play. That's the advocacy work that we do on behalf of our members.
It feels like an awful lot of change for the sake of capturing a very small percentage of the unscrupulous traders at the bottom of the market. And particularly when I kind of feel like the Commerce Commission, certainly of late, has been a very active enforcer of the rules compared to what we see with other departments on other legislation that does affect dealers. Do you feel that's fair? I mean, we've seen again today another enforcement action from the Against a Finance Company.
Yeah, look, we think that the Commerce Commission has stepped up. I guess part of this whole process is to have provided them with more resource to be able to do the enforcement role that they needed to. So that's been one of the constraints that they've worked under. But I think the other thing is that their process was very long and very slow, and basically their only recourse was to take someone to court. And so it had to be a fairly serious breach of the law for them to take someone to court. And then the court process, of course, takes an awful long time to get to the point of particularly any kind of redress for the customer. So, the new Act in some ways has done some good, I think, for vulnerable consumers. I think the first thing is that it's actually defined what a high-cost lender is, which is anybody that's lending at a rate of over 50% per annum, which, of course, doesn't include any of our members. And it has put an interest and fees cap in place so that those lenders can't charge more than 0.8% per annum per day per annum, which is about 292% per annum. It's still very high, in interest and fees. But when you see that there were lenders charging as much as 800%, that's a huge improvement on where we were before. And it's also given the Commerce Commission more powers to put in place things like an enforceable undertaking, for example, without having to take someone to court. So saying, right, we don't think that this behaviour that you're undertaking is good enough. We want you to undertake to us that you will stop doing it. And if you don't, we will take you to court. But at least there's a way of providing that consumer protection without it having to drag on for a couple of years while it goes through the court process.
Yeah. And I almost feel like there's a positive here in that, I've read pretty much every Commerce Commission case that reaches an end in recent years. And it feels like most of them they've been ending up only really being able to solve the ones that are acting with relatively responsible lenders already who are willing to negotiate a settlement, as opposed to they seem to have far fewer wins on those tougher cases that do have to go to court.
The tougher cases just take so much longer. The setting of credit fees is an absolute science, for example, and what you can include in your fee and what you can't include in your fee almost requires a forensic accountant to try and figure it out. And so there will always be lenders that
ultimately
get on the wrong side.
Ultimately, it had to go to court to set it to work out that in the end, didn't it? The Sports Zone case.
Oh yeah, the Sports Zone case, exactly. But even beyond that, it's still what can be included and what can't is still something that a responsible lender can be caught on the wrong side of it through no fault of their own, just because it seemed to them that this looked appropriate and their legal advice or their accounting advice said, that's directly related to that particular loan. and then the Commerce Commission's view is that it's not. So, they're very picky sort of things that can actually trip up responsible lenders quite easily. But I think the other thing is that the key thing is that the people that are charging outrageous fees, outrageous interest, who are not doing any kind of assessment of whether or not the loan's affordable, or not doing sufficient assessment, who are getting the people into situations of hardship and just that horrible debt spiral that people just can't find a way to claw themselves out of.
Mm-hmm. So, I mean, if we do talk about the kind of key changes, and we've kind of touched on one there, and that is affordability. There's a whole range of new requirements when it comes to assessing affordability. Can you tell us about that?
Yeah, there are. I think, there's a lot of significant change coming, but the really significant, the two really significant pieces, in my view, are firstly that the lender needs to determine that the loan product that they're offering is suitable for meeting the customers' goals and objectives. So in some cases, and fortunately probably motor vehicle sales is one of those, it can be relatively simple. They want a personal loan in order to be able to purchase that particular motor vehicle that they've spotted on a dealer yard and they've fallen in love with. That's relatively simple. The next part then is the assessment of affordability. So you gather the information from the customers about their fixed commitments. Then you'll gather information from them about, you gather information about their income. You'll gather information from them about their fixed expense commitments. Then you'll gather information from them about their other expense commitments. So that could be some of their discretionary spending. And you, all the way through, there's an expectation that you'll be verifying the information that they provide you, particularly if there's any suggestion that the income could be overstated or the expenses could be understated. There's also a requirement to include a surplus or a buffer over and above that to cover off that underestimation of income, underestimation of expenses and overestimation of income. And then eventually you get to this point where you might be able to approve the loan. But I mean, when you get to things like discretionary expenses, for example, like where people purchase takeaways a couple of times a week, or where they take a couple of $100 a week out of the ATM, and where that might make the difference between the loan being affordable or not being affordable, the requirement is to ask a lot more questions about, is this expenditure that you would stop in order to be able to afford to repay this loan? And then there are quite rigid expectations around the keeping of records of the conversation that you had with the customer. So, I spoke to Richard and he said he was going to only do takeaways once a fortnight in order to be able to provide a more of a surplus and make this loan more affordable. So that, if it gets to a point where you default on the loan because you're still doing takeaways a couple of times a week, there's a record of the fact that the lender actually had a conversation with the customer about, what they were going to do about their discretionary expenses and discretionary spending to make the loan affordable. It's a lot more in depth. It's very intrusive, in my view. I don't really want to have to talk to a lender about where I spend my money. It's my money, I earn it.
Exactly.
If I want to spend it the way I want to spend it, I don't want anyone, I totally understand that you need to have a view of people's fixed expenditure, so their fixed commitments like their rent and their insurances and their, mortgage payments and other loan repayments that they might have and those sorts of things. But then what they do with the rest of their income in a lot of ways is their own affair. And one of the things that we are concerned about is that consumers aren't aware that this is coming to a large extent. And we're so involved in it and so immersed in it and have been for the last 3 years that we've sort of forgotten to a certain extent that actually this is going to come as quite a shock to consumers, particularly if they're repeat customers. So they go back to a dealership that they've dealt with for years. They've had finance through them before, and they go back to arrange finance for the next model that they want to purchase. And all of a sudden they're being asked all these really quite intrusive questions about, why do you take $200 a week out of the ATM? What do you do with that? And is that expenditure that you could stop in order to be able to pay this loan? And they'll be sitting there going, but we've been paying you back with no problems for years. You know us.
Yeah.
So I think that the dealers themselves are going to have some interesting conversations with customers, because they are going to find it a really different process from 1 October.
It's almost like the dealer's going to have to just about become a financial counselor in some of these cases. It's
just about, yeah. And look, the thing is that all the responsibility falls onto the lender to get this right. So dealers really, you said it yourself right at the beginning, dealers need to be guided by what their lenders tell them to do and what their process is. And we can't stress that enough, that, the lenders, following the lender's process is really, really important, because of the fact that the lender themselves, their senior managers individually and personally, the lending company and their individual senior managers and directors also have personal liability if they get this wrong.
Right. So there's now personal liability for the lender's senior management if these issues come up.
Yep.
Right, and I understand there's additional verification requirements for all this extra information you've got to collect as well.
Well, in order to be certain that you've actually got the information that you need, and that you have actually really understood the customer's expenditure and income and that sort of thing, then there will be a requirement for more verification. You can no longer just take the customer's word for it.
Right. And particularly, if a dealer's selling on a Sunday, that might be difficult, I imagine, to secure some of that verification.
There are ways of doing it. There is technology, and a lot of our members are looking at the technology and how to use that. But there are ways in which you can securely access bank account information, and the customer can do that via their phone, and then it just gets downloaded and provided to the lender. And it is 100% secure. But the problem that a lot of lenders find is that customers are reluctant to do that. They think that they're actually giving away their banking internet ID and password, which of course their banks are telling them never to do that. And where in fact they're not. It's not captured anywhere when they use those tools. But even they're great tools, and they do classify all the expenditure information under different headings and give you all sorts of understanding of what the customer spends on a regular basis and all that sort of thing. But again, I think it's something that a lot of customers won't have encountered before. It'll be something quite different for a customer, and there will be a bit of reluctance, I think, on the part of consumers, particularly if they don't understand why all of a sudden they're being asked all these questions.
Mm-hmm. Are there any other key areas of the changes that you think dealers need to know about?
I think that the suitability and the affordability piece are the most important, but I think, we have talked about the personal liability on directors and senior managers of the lending companies. All of those people have got to be certified by the Commerce Commission as being fit and proper persons to be able to hold those roles, and that's quite a process as well. They have to individually apply to the Commerce Commission to be certified as being both being a sound enough character to be able to take on the role of a director or a senior manager. So that means that they've got to do things like police checks and all of that sort of thing. They've got to certify that they've not got any convictions and all of it, et cetera. Plus, they've also got to provide evidence of their competence to actually fulfil the role. So things virtually like providing their CV to show the Commerce Commission that they can actually do the role. The personal liability could be as much as $200,000 per person if they're found to be in breach of any of the provisions of the Act. And it's a real incentive to get it right. It's probably a disincentive for a lot of people to want to become a senior manager or a director of a finance company.
Yeah, I mean, there are some dealers now who have their own lending operations. I mean, this could perhaps push some of those businesses over the edge to just say, too much, not worth it.
Oh, without a doubt. The compliance is getting more and more onerous. It's not getting less onerous. So, because the more onerous it becomes, the more likely it is that you can miss something So I guess that's another one of the roles that the Financial Services Federation has in the process, is trying to make sure that our members at least are fully up to speed with what they need to know to be fully compliant, because we don't want to see any of our members on the front page of the next issue of AutoTalk or the Herald or any publication saying they got it wrong, they were in breach, their directors are being fined and all of that sort of thing. It's just, it's just not a good look. But so I think, for small dealerships that are running their own finance book, they need to get themselves up to speed as soon as they possibly can.
Mm-hmm. Now, there is some impact on the insurance side of the market from this. Can you explain what needs to be taken into account when you're selling insurance products within the dealership now, and for the insurance providers themselves?
Sure. Well, the insurance, the onus all comes back on the lender, particularly if the premium is being funded by the loan. But the requirement around the suitability of the product, to ensure that the product is suitable for the customer's needs. In terms of insurance, what that looks like is, is this a product that is appropriate for the person, considering the range of other insurance products, similar products that are available in the market? Then the dealer is not going to be expected to actually know exactly what products are all available in the market, and certainly not expected to step over the line and give financial advice. So they need to steer very clear of saying anything that says, I recommend that you take this product because it will do this, this, and this for you. That becomes personalised financial advice. But what you can do is say, this product is available. It protects either your asset or it protects yourself in terms of your repayments, and therefore, we think it's something that you should have a look at. But really, we can't recommend or advise people to take it. So
they're asking salespeople not to sell, really, in that situation, aren't they? I mean, that's the sizzle.
Yeah, exactly. Yeah, and it's hard. You've got to sort of almost script it to make sure that you don't step over that financial advice line. But the point is that the product has to be suitable. There has to be a good chance that the person's going to be able to claim on it if something does go wrong. Which would seem to be, fairly self-explanatory, but apparently there have been cases where that's not been adhered to, and again, the lender then has to take into account the whole affordability process for the loan to include the insurance premium if it's being added to the loan.
Okay, and of course we've spoken about this before. Just to throw into that affordability mix again, next year we've got the Clean Car Standard penalties, which of course have got to be included in affordability as well when financing a vehicle.
Well, yeah, that's right. Yeah. So as you say, there are a lot of things coming the way of the motor vehicle industry at the moment.
Now, what resources are available out there to help dealers to understand all this? I mean, aside from information we provide through AutoTalk, obviously their financiers are going to be or their lenders are going to be a key source of information on the steps they need to take. Is that your main advice? Talk to your lender, or is there any other areas they can seek information?
Absolutely, talk to your lender, because the work that we're doing with our members at the moment is to make sure that they're up to speed. So we've already commissioned Chapman Tripp, the legal firm, to do a very comprehensive compliance plan and checklist of all the things that are changing in the CCCFA. So that includes the Act itself, the new regulations, and the Responsible Lending Code. And our members are working through that as part of their project plan to make sure that they're fully compliant by 1 October. So that's the first thing. The next thing is that we've also working with a training provider to provide frontline training. And I know that some of our members are looking at putting their dealer networks through that frontline training as well. So this is around what they need to know about the changes to suitability and affordability. They'll also the lenders themselves will also have to do on the ground training with their dealer networks as to how that then applies to their own lending process and their own individual credit criteria. So, their appetite for risk, for example, and that kind of thing.
Fantastic. And if you are a dealer that has your own book, and there are a lot of them out there, I guess they're best to come to you guys and talk, because it sounds like it's a time when they really do need the help of the federation.
If they haven't thought about Triple CFA now, then they've got a very small window to be fully compliant by 1 October. We are asking the Minister of Commerce at the moment, but we haven't had any confirmation yet, whether or not there is any appetite to push that deadline out, given that we've got a lockdown at the moment. Most of our members are based in Auckland in terms of their head office, and that's where a lot of their project work is being done to become compliant. And of course, they can't get out and do training face to face. They can't send their business development managers out to the field to talk to people, even under level 3. So, it seems reasonable to us that they should grant an extension, but you can't always guarantee that you'll get what you want. But yeah, absolutely, we would be happy to talk to any dealerships that are running their own book.
Excellent.
About how we can help them.
I'll put a couple of links, Vicky, to the FSF in the bottom of the YouTube screen or the podcast notes if you're listening to this on a podcast. But fantastic. Look, thank you so much for talking to us today, Lyn. That's been super insightful. That's Lyn McMorran from the Financial Services Federation. Please don't forget to like, subscribe, or share this video or podcast wherever you're listening to it. Check us out on Facebook, and my LinkedIn page is also a pretty good source of information coming out from the industry too. So thank you for joining us, Lyn, and we'll see you everyone again soon with another great video from AutoTalk.
Thanks, Richard.